Then speaking to Anand Shah of ICICI Pru, the conversation has been very interesting in terms of what's in store when you talk about Indian equities in 2026, sectors and themes to bet on, and the key highlight over here is how should you be playing the bottoms-up approach from here on. Let's quickly listen in to that conversation that I had with Anand Shah.
Happy New Year to you, entire crew at NDTV Profit and all the viewers. Wishing them a very happy and prosperous and obviously the healthy 2026 to all of them.
Yeah, healthy and wealthy, I think. Wealth is what they're looking for from you, Anand.
Sure.
So, Anand, my question coming to you is over here, the way we've seen 2025 pan out, right? It's been a roller coaster ride across policy, across markets. There has been no particular direction, I mean, a lot of global events that we've actually put our backs to. The question from here on is, what is your key expectation from markets in 2026?
No, so I think 2025 has been a forgettable year, but if you see in the context of the global emerging markets, it was a disaster. So India would have done in dollar terms approximately a flattish to 0.5% positive. But the global emerging markets are up 29.5% so far. So we have a massive underperformance of almost 29% plus. And this in last 2 decades has been one of the highest underperformance for the Indian equity markets versus global markets. And to be very honest, that also takes away one of the issue, which was the premium at which Indian equity markets used to trade relative to the other emerging markets. So I think that to that extent, the valuations is not so much of an issue. Couple of things, we started the year saying, we had a fabulous 4 years on the markets and there needs to be a reset in terms of expectations. I think that stays. The returns in the markets over the next couple of years would be far more subdued than what you have seen. Couple of things that have happened positive is obviously monetary stimulus or basically the monetary stance remains fairly growth oriented. So not only interest rate cuts, but ample liquidity has been provided. On the fiscal front also, government has done certain initiatives to kickstart the consumption, be it in terms of tax incentives or GST cuts, or even we would see some bit of money in the form of pay commission. So I think those are the positives that are there for the economy and to that extent to the markets in the coming year.
Okay, that's interesting. Let's break it down. If you're talking, Anand, about earnings growth and multiples, the expectation is that probably corporate earnings growth will accelerate in FY27. Will this be a primary driver for the market performance from here on? Or is there, room for a valuation re-rating from current levels according to you?
No, I think the market expectations have to be in line with the earnings growth rate, which in turn would be in line with the nominal GDP growth rate. I think we have seen a massive earnings pickup for India Inc. between 2020 and 2024. The profit to GDP from the lows of 2% that was there in the March 2020 has now reached again above 4.5%. So I think to expect the profit to accelerate faster than nominal GDP growth rate from here on would be a little far-fetched. It can happen for a year or two, but it cannot be a structural. So that's one part. Similarly, on the price to earnings multiple also, I think we had a lot of segments of the market, especially in manufacturing allied, corporate banks, PSU banks, which are extremely cheap starting 2020, 2021. They have also got re-rated. To that extent, I don't see too many pockets where the valuations are cheap that there can be a PE or a price to book re-rating. So I think the expectations needs to be muted more or less in line with the nominal GDP.
Okay, so muted expectation in line with the nominal GDP is what you should be looking at. If you have to talk about the global, markets, especially from the US Fed perspective, the interest rate cuts, along with that, you're talking about a potential weaker dollar influence. Will that really impact or influence your projections when it comes to reversal of F5 outflows back into Indian equities?
Indeed, as I said, India has underperformed the emerging markets by almost 29% and similar numbers compared to the world equity market. So I think the valuations is no more relative to the world. Absolutely, it might be still expensive, but relative to the world is not that much of an issue. Coming to the flows, I think given that AI was the theme last year, India was also at the receiving end in that terms that we saw one of the highest outflows from FIIs. From September peak of the markets from September 24 till date, it would be approximately 26 to $27 billion of outflows from FIIs that we have seen. So things can change given that we also believe that the valuations in the US equity markets and generally in the AI related companies and value chain remains fairly premium. A slight change in the sentiments away from AI into other markets would definitely lead to some possibility of some flows coming back to India, given the valuations are attractive and the growth would be far better this year than the last year.
So Anand, I'll pick it up from where you left in terms of the AI sector, right? I mean, it's high-flying US AI sector is what we're talking about. Anticipation is that probably it could be a bubble, there could be a correction coming in there. We're talking about India probably who's late in terms of joining the bandwagon, but the kind of investments your Indian IT companies are making when it comes to AI, in terms of data centers et al., is something that everyone is watching out for. How strong do you think is then the domestic economy as compared to being insulated from any of these global market, reactions?
No, so the way I see AI is very similar to what the telecom was in 2000. The issue was not that whether people will use data, people will use transport data from one continent to other continent, and whether they will use telecom into the next decade. I think that happened and people did consume. But even then, a lot of telecom companies went bust, which was an issue of cash flow rather than the viability. Similarly, we believe AI is here to stay. AI will remain an industry which will be extremely useful for corporates and individuals at large. And eventually, there will be a couple of companies which will survive. But today, the extent of overinvestment and the premium valuations at which the AI stocks are trading both makes me believe that there are extreme risks to AI stocks at this point of time. Coming back to Indian scenario, I think the Indian IT companies are more of enablers rather than creators, and to that extent, through the various transitions of technology in last 2.5 decades that has happened, be it Y2K and be it subsequently internet and SAP and everything, I think they have transitioned and they have been remained useful for the global corporates through every technology transition, and they will remain relevant even for the AI.
Okay, so with all of this said and done, Anand, which are the sectors that you would have your eyes on in 2026? Because the moment FIs make a comeback, you always see a comeback of the BFSI and the IT space. BFSI as a sector has been really strong in 2026 as well. IT, I mean, it's pretty dilly-dally. So your sectors that you would be wanting to look at?
So our topic remains BFSI. I think we have a combination of both private sector, public sector banks, which are in a pink of its very healthy balance sheets. Their approach to the market remains conservative, and to that extent, that remains a compounder for us. We have a fairly good exposure to the banks, life insurance, asset management, wealth management, in that sense that the financialization of savings, which has started with RBI making real rate of interest positive. It started actually through Demon and so on and so forth, has benefited all these sectors which participate in the financial savings. So that's one piece. Separately, on the consumption side, we remain more optimistic on the services side of the economy than the products. We believe the penetration story in consumption in products, depending on various categories, is fairly good, and to that extent, the growth will be at best subdued Whereas services is the new segment of the consumption which will be sort of get penetrated in the Indian middle class, and that's where we believe the growth will be a little bit faster. And within the consumption space, we prefer services over products. And lastly, our favorite had been for last few years have been manufacturing and allied sector. There we have reduced our exposure given the stocks have done extremely well and the valuations are not cheap anymore, but we still remain overweight on manufacturing allied, but it's more bottom up than top down. So when you're asking me sectors, we believe a lot of these sectors already been explored and the valuations are not cheap anymore. From here on, it will be more bottom up. We might like a sector, we might not like a company, and we might not like a sector, but we still might like a company in that sector. So it's very bottom up from here. The theme for 2026 is narrative to execution and from macro to micro. I think a lot of these companies have shown a lot of promise, but they need to execute this year. And similarly, for portfolio managers like us, we'll have to go more bottom up, identify businesses which will win, notwithstanding that the nominal GDP growth rate will be in the range of 10 to 11%.